the half-year results are probably out now in the market about 3 weeks, so many of you may be quite well acquainted with the results. And you would have seen that it was a very solid result for the business in the first half, and the market reaction accordingly has been very, very positive for the stock. But just before I go into the actual results, for a quick reminder for people, the Nanosonics, the core business that we're involved in is in the area of infection prevention. We've got a core technology that has now been marketed around many countries around the world for the low temperature, high level disinfection of ultrasound transducers. And as you would know, ultrasound is a fast growing modality in the medical arena, and of course you would hope that between usage in patients that the actual ultrasound transducers are decontaminated. So we've got a very novel technology, automated technology, that goes in and makes that very, very seamless, cost effective and safe to be done at point of care in the hospital system. We've been on the market for a number of years, and indeed becoming standard of care. Our technology is becoming standard of care in a number of markets. Here in Australia, probably around 75% market penetrated. But very, very pleasingly, in the United States, the biggest single market for us, it's now truly is becoming standard of care. There would not be a single luminary hospital in the United States that does not have this technology. And indeed, of the 40,000 potential that's in the United States, we're already at about 17,000 units across 4,000 or so centers. So certainly a technology that has been adopted very, very well and broadly. In terms of the first half and some of the highlights for the first half, well, from a financial perspective, a very strong result in that our total revenue was up 36% on PCP and 33% on the prior half. But what's important to understand here from an investment perspective is deconstructing that revenue, because really the revenue is associated with selling capital equipment. But really the investment thesis is one of the annuity revenue that comes with that capital equipment once it's placed in a hospital, and that's in the way of consumables. So indeed, probably, on that basis, one of the most important metrics for the company is the installed base of the capital equipment continuing to grow strongly, because it is, well, then you've got that annuity stream of revenue that follows through. So when you see we've broken down for the market a bit of detail in terms of the capital revenue and then the consumables/service revenue, which is the annuity revenue. And again, a very, very strong result in that on the capital revenue is up 11% on PCP, but up 52% on prior half. Now, it is important to explain that 52% because in April last year, we had earlier than anticipated approval of the second generation of our trophon device. But we did not launch that device into market until towards the end of August, September. So consequently, we had people deferring the purchasing decision until such time as they saw what the new technology was, and also our distributors destocking in anticipation of a new device coming. So the second half of last year was a pretty flat year. But then when we look at that 52% increase in capital over the last half, that's because you had in the half just gone, we've had suppliers and distributors restocking now with the new device, and the installed base now kicking in again and continuing to grow. But so that's some of the important insights behind those actual numbers on the capital. On the consumable side of things, again, a very, very positive result, and you're seeing nearly a 60% growth in consumables over the prior corresponding period, and up 22% on the half. So, and again, as I mentioned, really the important thing in this business is about growing the installed base, because with that installed base comes the annuity from the consumables. And on that installed base, you'll see that the installed base over the last 12 months has grown over 20% and 9% in the half. And that 9% is not necessarily associated with slowing. It's got to do again with the timing of the introduction of the actual new technology. So a very strong set of overall results for the business. In terms of some of the other key activities for the business over the half, we've been spending a lot of time from a geographical expansion perspective. So in the half, we've now partnered up with GE Healthcare in a number of new markets in Europe, across the Nordics and Spain and Portugal. And we'll be now introducing a machine specifically for those markets that has the local languages. We've been spending a lot of time in our business in Japan. And Japan is one of those countries where they actually do not have guidelines yet that require you to decontaminate probes between patient use. And so we're very much in business and market development mode up there. But one of the key activities over the last 6 months is we completed a pivotal study to demonstrate that the probes are highly contaminated, just as every other study in all other countries where it's been done has demonstrated. And indeed, the study demonstrated that over 90% of the probes studied were contaminated. And of that contamination, 50% of it was pathogenic. In other words, harbored microbes that can cause disease, including MRSA. So we'll now leverage that. That study will be published up in Japan and will actually be presented at the Japanese Society of Obstetrics and Gynecology in April, and work with the societies. We've got more studies to do, but we'll work with the societies to actually generate some guidelines. This gives you a bit of an idea as to the installed base across the different regions. So up 20% in the last 12 months on PCP in globally. In the United States, that's up 21%. In Europe and Middle East, up 33% on the over PCP, and 10% in Asia Pacific. And just at 10% in Asia Pacific, the reason that's slower than the others is the primary markets for us at the moment in Asia Pacific are Australia, New Zealand, and we're already highly market penetrated in those markets. The other Asia Pacific markets are in market development mode. So again, very good adoption and ongoing adoption of the technology, where by the end of December, there's just over 19,000 units in operation. It's probably worth mentioning from the different types of sales models that we actually do deploy across the different geographies. And we've got to split it down, because in some markets we've got a direct sales force, like in the United States. We've got a full operation over in the US and in the UK. And in other markets we work through distribution. But in the direct channel, there really are three types of sales models. One is, which is the most common, that's where we'll sell the capital equipment and we'll sell the consumables. And the capital equipment will range anywhere from 6,500 to 8,500 USD, depending on the model. And each unit that is placed will generate approximately 3,000 AUD per annum in high margin consumables. Then the other model that we have is called the managed equipment service model, and that's very, very unique to the United Kingdom. And over there, it's really difficult to gain access to the NHS capital budgets. So what a lot of companies do is effectively place a fully maintained machine within the hospital and then charge an all-inclusive price that comes from the operating budget for the consumables. So effectively, we don't generate then capital revenue, which is important to understand. But what we do is generate almost double the price, or get about almost double the price for the consumables. So each one of those machines would generate close to 6,000 AUD per annum. And then rental, where we just rent over time the machine and people pay the standard price for the actual consumables. And then on the distribution side, it really is a mix of two things. One is a full service distribution. That's where we have a distributor that will have access to sell the capital, the consumables, provide service, just like GE Healthcare in those markets I mentioned earlier, and indeed GE Healthcare in the United States. Or a capital reseller distributor, and that's where a distributor just has access to the capital equipment. And once they sell the capital equipment, and those capital resellers are primarily ultrasound OEM companies like Canon and Toshiba and Philips, etc., where they may want to bundle our equipment when they are selling an ultrasound. But that customer will ultimately become a customer of Nanosonics for the ongoing provision of consumables, etc. So mentioned the financials, very strong revenue. You know, in the deck, for those of you that are interested, it goes into quite a granular level of detail, looking at the financials by region and split into capital and consumables. But I think the overall revenue and that split tells the story. And from a P&L perspective, you know, we generate an operating income before tax of $11 million in the half, and the organization has a strong cash balance now. I mean, we're positive free cash flow, but we've got a positive cash balance at the end of December in the order of just over $71 million. And that cash balance we're still a growing company, still in investment mode, a lot going on in R&D, a lot going on in geographical expansion. And what that cash balance ensures us is that we've got the capital to be able to continue to invest for the longer term growth of the business. So in terms of the overall opportunity for the current device that's out in the market, we're looking at about 120,000 units globally, and that's split down pretty equally amongst the 3 different regions. So about 40,000 unit opportunity in the United States. As I mentioned, we're almost about 43% penetrated there, and quite under-penetrated in the other markets. And that under-penetration is associated with the fundamentals for adoption were not strong, but they are now strengthening with the introduction of more and more guidelines in individual countries that are mandating that these probes need to be high-level disinfected. So the good news here is the fundamentals for adoption are already strong, or they're weak and strengthening. There's no market where they're strong and weakening. So we should see now continued growth in the other markets where we have increased our footprint, in particular in Europe. And, you know, from a geographical perspective, we are now represented in all major markets around the world. Some of those in selling mode and some of those in market development mode, but we've now invested quite a lot of time and effort in giving ourselves a large geographical footprint. And that's not just for the trophon device, but our intention is to bring another new product, non-trophon related, in the area of infection prevention to market by the end of FY20. I'm going to skip through and just mention one thing is, you know, as the business is growing, we have added a number of very senior new executives to the business as well to you know, really to strengthen our capability and capacity. 2 of these are ex-Cochlear executives who are very well known to me, as I was on the executive of Cochlear for 12 years. We have David Morris, who's joined as Chief Strategy Officer and Head of Asia Pacific, and he was Chief Strategy Officer at Cochlear. But also Rod Lopez, who's joined as Chief Operating Officer, and Rod headed up all manufacturing logistics operations globally for Cochlear for over 15 years and transformed manufacturing over there. And also, in addition to the team of Renee Salaberry as Chief Marketing Officer, and she's got a very distinguished international career in marketing, and actually rose to the heights of Executive Director of Global Strategy for the likes of Leo Burnett and Publicis, like the second and third largest agencies in the world. So we're attracting very, very strong new talent to the business. So in terms of the outlook for the business, for the remainder of this half, it has not changed pretty much to what we had said at the very beginning of the year. We expect continued growth in the installed base. We expect European markets, adoption in those European markets to now start to kick in because the fundamentals for adoption have actually strengthened. We've just completed the first study in Japan. We intend to conduct a second study. We'll commence this half, but we'll get publications in Japan, and we will be working with the societies, working towards guidelines for Japan. On the OPEX side of things, we're looking at about $50 million for the year. A lot of that skewed into this second half, maybe about $29 million in this second half, and a big chunk of that going into R&D associated with the new product. And so beyond FY19 for the business, because and that's what's really important. This is not a business that we're looking at on a 6-monthly basis. We've got quite a long-term strategic growth agenda, and that agenda really has 3 pillars to it, and that is in those markets where we now have a geographical footprint to establish our technology, the trophon technology, as standard of care, and as demonstrated in a number of those markets, that now is actively happening. But also to introduce the new products to market. And what we're saying to the market is that from our R&D efforts, we intend to bring, subject to regulatory approval, a totally new non-trophon related, non-ultrasound related infection prevention product to market by the end of FY20.